Hello everyone, welcome back to S&B Trading. Today we got our FOMC minutes release, just dropped about an hour ago. I've been reading over it, just trying to find some interesting things about this, because a lot of this, every time this comes out, I mean, the market, the volatility spikes up, we get some crazy candles. Looking at the market, if we just jump over to the Nasdaq real quick, you can see it comes out, we get some volatility, we get some nasty candles, ugliness, and now we're just really heading for the lows. So market's not reacting well to this, but I didn't really expect it to change anything. It wasn't going to change the direction the market was heading. It was pretty clear we had some low volume ripping going into it, so that was already in my head like a red flag. Like, yeah, this ain't gonna last. So sure enough, we just get a liquidity sweep at the high of the day. That's really all that happened out of this FOMC minutes that came out. We just got a nasty liquidity sweep where we had some wicks go up, we trapped some bulls, and now we're yanking it down. So jumping back into what actually happened in these FOMC minutes. Now, mind you, this is very this is way behind. This is from the FOMC meeting January 31st to the 1st of February. We have had new CPI numbers. We've had new PPI numbers come out. We have a new PCE number coming out this Friday. So a lot of what they are talking about in this has been completely destroyed because of this new inflation data that shows inflation has spiked back up. A lot of this is them talking about, like, yeah, we like where goods inflation is going. It's heading down. We are still seeing that sticky service side inflation, which is more than half of the PCE, the core PCE number, which is that's the holy grail for them. That's their best metric on inflation. That's what they look at, is core PCE. That's excluding food and energy because those are so volatile. Services is more than half of that, and that's really what they talk about in a lot of this. One thing I think that is very noteworthy, and that I think the market is probably reacting to the most, is the mention of a 50 basis point hike. This little spot I have highlighted here. A few participants stated that they favored raising the target range for the federal funds rate 50 basis points at this meeting, or that they could have supported raising the target by that amount. The participants favoring a 50 basis point increase noted that a larger increase would more quickly bring the target range close to the levels they believed would achieve a sufficiently restrictive stance, taking into account their views of the risk to achieving price stability in a timely way. So we kind of knew this. Powell he gave us little breadcrumbs leading people to believe that there were some on the board that thought 50 basis points was appropriate last month. Now, looking back in retrospect, I imagine they wish that they did do 50 basis points, because now we know inflation is coming back up. It's bubbling back up this over January. I mean, PPI was terrible. CPI was horrendous, the highest it's been in like 6 months. I'm sure if they go back in time, they would all be like, if we knew January inflation was going to be this bad, we would have done 50 basis points. So why is this important? Well, we know that the seeds are there in the FOMC. We know that there's people that are like, come on, guys, this shit, this ain't no joke. This inflation, just because the goods has come down a little bit, it's mainly because of gas prices. It's mainly goods inflation, which is very volatile. It's hardly any service side inflation, which is more than half of the metric that they use. So these smart people on the FOMC were sitting here like, guys, come on, we cannot be slowing down yet. Inflation is nowhere near where we want it. But the vast majority of the board was like, hey, we think it's coming down. Look at the CPI and the PC. I mean, it was coming down toward the end of last year. It has been coming down. All of that's nullified now. All of that's out the window. We know inflation is coming back up over January. So now that we know that, it isn't crazy to think that, hey, I'm sure a lot of these people on the FOMC are changing their minds. They're probably listening to these people that were trying to tell them to go for the 50 basis points. So I think that's very concerning for the market, because if you read through this, I mean, you can't really read through. It's just not important. You can't read through this and take a whole lot out of it, because a lot of it is just like, yep, we're seeing that goods inflation coming down. It's coming down. But that's not true now, because the January numbers came out and they were terrible. Another interesting thing I found was this little snippet here was participants agreed that they had observed less evidence of a slowdown in the rate of increase of prices for core services excluding housing, a category that accounts for more than half of the core PCE price index. That's their top dog, core PC. That's what they look at. That's number one. Participants judged that as long as the labor market remained very tight, wage growth in excess of 2% inflation, and trend productivity growth would likely continue to put upward pressure on some prices in this component. There you go. We're back to the labor market. I've been saying this for a while now. It's going to be all about the labor market. Goods inflation can come down. It can come down easily. If gas prices go down, goods inflation usually follows. That is easy. Service inflation, not so easy, because we know no one's losing their jobs. No one's getting laid off outside of tech, which is like a tiny little chunk of the entire labor market. We know these things are true, and it is snowing like crazy outside right now. Okay, sorry. Shocking where I live to see that in February, actually. Holy crap, big snow. So we know those things aren't coming down because the labor market's not moving. So where are we headed? Where higher rates? Probably. Later pause? Probably. Because we just haven't seen any movement at all in the labor market. The labor market is still acting as if interest rates are at 0%, which is crazy because interest rates are not at 0%. They're almost at 5%. So it's just like they're thinking, how high do we have to go before people start losing jobs? And now I know that sounds terrible, but that is 100% what they're going for. They're never going to say, yeah, we need people to start getting fired, but that is what they want. That all this talk about the labor market, that's what they need. Because that is what gets people to stop spending so much goddamn money, is when they're like, hey, I might lose my job someday. I got to cut back. They know these things. They're not going to say it because they're all crooks. They don't give a shit about you. You're just a little pawn in their game, but that's the way it is, unfortunately. Other things I found a little interesting. So a lot of people act like the FOMC doesn't look at the stock market. They do. They don't look at it nearly as much as the bond market. That's their main cup of tea, but they talk about this here a little bit. In particular, the staff noted that measures of valuations in both residential and commercial property markets remained high. So we know this to be true. We know that sales on housing has fallen off a bit of a cliff, but the prices just they're not moving. The prices they've come down a little bit from like the peak euphoria that the housing market was in back in 2021. But it's not moving down enough for them. They want housing prices to come down. They don't say that explicitly, but that's what they want. They need that to happen. And Powell said that back in March of 2022 of last year. He said, hey, if you're a first-time home buyer looking to buy a house, he kind of was like, you might want to wait. You might want to wait a little bit. He was like dropping little hints. He said there's going to be some pain ahead. He literally said if you're looking to buy a house for the first time, I would wait. So what do you think that means? What do you think they're trying to get out of the housing market right now? They're trying to get everything to come down, but they're like, shit, things aren't really coming down. So property markets remained high, commercial and residential, and that the potential for large declines in property prices remained greater than usual. They want that, of course. They want that. They're not like, oh shit, if housing prices can drop a lot and still just be above what they were like 5 years ago. That's how crazy housing prices are. I don't need to tell anyone about that. So they're not worried about housing prices dropping 20% because it would hurt, but it's good in the greater scheme of things. It's good for those prices to come down because it's not normal where they're at. It's a big cause of inflation. It's the wealth effect. When you are some guy who bought a house 10 years ago for $200,000 and now that house is worth $500,000, your wealth has increased exponentially. Not exponentially, but a lot. And that is a big cause of inflation when you are just now this much richer because you bought a house 10 years ago. And that's it. You didn't do anything else. But of course, on top of that, your wages go up, yada, yada, yada. You get raises. But that's a big part of it. So that's interesting that they're talking about that. In addition, the forward price to earnings ratio for the S&P 500 firms remained above its median value despite the decline. So that's another thing is that P&E ratios, forward P&E ratios, price to earnings, is still, even after the pullback last year, is still higher than it should be. And that is a big part of the bear case, is that we haven't even gotten to the point where stocks are anywhere near undervalued. Nothing is even close to being undervalued. Some tech companies are. Some other stocks, but I mean, like, you look at the Dow Jones and half of those are overvalued. You look at, you look at Coca-Cola, you look at some of these quote unquote value stocks. And I mean, these things are still sitting up here at all-time highs. You look at like McDonald's, I mean, they're still sitting at all-time highs. Looking at healthcare companies, still just sitting around their all-time highs. Looking at like Caterpillar's a good one. Just still sitting at all-time highs, basically, close to all-time highs. These like value stocks are no longer value stocks. I mean, they're still overvalued. So this is where you'll see the real stock market hit happen, is when you see these type of companies falling. But right now they just aren't. And I mean, these companies are still sitting at like over 20 forward P/Es, which is crazy. Absolutely crazy. I mean, Cat is at like a 15. So I mean, these things aren't even close to being undervalued. And that's a big thing. You got to zoom out on the chart, because I know you zoom out on the chart and you look at SPY, you zoom out and you're like, I mean, that one's a nightmare. You look at SPY and you're like, oh wow, it's really come down. But you really zoom out on the weekly, and it's like, this is all it's done. We are undervalued. We are nowhere close to being undervalued on that. So that's just interesting that they talk about that, in my opinion. Another thing that they touch on was the reopening of China. That has been a pressure on inflation to the upside, that has opened up economic value or economic activity in China, because they were completely shut down, as everyone knows. They've reopened. Demand in China has shot up because of that. And that, of course, I know it's like, why would China affect us? Our economies are in bed with each other. So these things pour over. They pour over into our inflation, unfortunately. I think I highlighted a zero COVID. Yes. Participants observed that the uncertainty associated with our outlooks for economic activity, the labor market, and inflation was high. Regarding upside risks to inflation, participants cited a variety of factors, including the possibility that price pressures could prove to be more persistent than anticipated due to, for example, the labor market staying tighter for longer than anticipated. Yep. Participants also saw a number of upside risks surrounding the outlook for inflation stemming from factors abroad, such as China's relaxation of its zero COVID policies and Russia's war with Ukraine, of course. Yeah. So that's kind of interesting to me. They're starting to talk about that. And we've talked about that before, how that could maybe be a black swanish sort of event, that that China's demand really doesn't help us. That's the last thing we needed, because that was disinflationary, was China being closed down. But now they're reopening, and now it's just like, here we go. Here's another thing. Another thing I thought was interesting, you type in disinflation in the old Control F search, there's no mention of that. They didn't even talk about disinflation. Not one mention of that. If you type in recession, they talk about recession a couple times. While most desk survey respondents expected subdued growth or mild recession in 2023, market participants continue to see notable uncertainties ahead, including prospects for a deeper downturn or the potential for more persistent inflation. Yeah, there's a plausible alternative, a chance of a recession. The probability of the economy entering a recession in 2023 remained elevated. Yada, yada, yada. So, I mean, this whole thing is just such a big nothing burger, and it's just been completely invalidated by all this inflation data that's come out. So I really don't need to spend that much time talking about it. I just found a few interesting snippets out of it that I think the market probably saw and were not thrilled about. The big one being that, yes, there are people on the FOMC that were like, we need to keep doing 50 basis points hikes. And I know we were doing 75 basis points back last year, but I mean, we were doing those back when the rates were still only at 2%. So the fact that we're close to 5% and these people are still wanting 50 basis points is intense. That's intense. That's very hawkish. That's super hawkish. Looking at the 10-year yield, it's still ripping to the upside, man. I mean, today it's down a little bit, but you look at this, I mean, it's just been shooting up, just skyrocketing. Not great. Not great. Yeah, it's up 20%. Whew. So those mortgage rates, those are going back up, baby. Those 30-year fixed mortgage rates, those are heading back towards 8%, which is good. So now the market it feels like it just got way too ahead of itself. It feels like we were already celebrating a mile away from the finish line. It's done this before. It's every rally has been the market doing this. And then what happens? New data comes out. Reality sets back in. Oh shit, we're nowhere clear. We're nowhere near being in the clear on inflation. I know, it sucks. I would love to talk about good news like inflation's coming down, everything's happy and cheery, but there's just no chance that this entire mess could have been resolved in 1 year and only a 20% downturn in stock prices. There's just no way, in my opinion. I could be wrong. I don't know the future. Nobody knows the future. But it seems like things are more uncertain right now than they have been at all, because at least last year we could say, hey, we know the Fed is trying to get those rates to like 5%. We know it's going to be paying. At least last year we knew earnings, but now we're like, hey, earnings, yeah, everyone keeps reducing their outlook on earnings and they just keep dropping them. But now it's like, how bad is it going to get? We don't know. Is inflation even going to respond to 5% rates? We don't know. Is the Fed even going to stop at 5%? Are they going to pause at 5%? Are they going to reverse rates at the end of this year? A lot of uncertainty. And not to mention the global uncertainty going around now in China. Now we're hearing about Russia wants to invade Belarus by 2030. Things don't feel good right now. Things just don't feel good. And the fact that stocks are just coming off a crazy rally. I mean, it was just a 1 month, just absolutely insane rally, is really concerning. And now it just looks like hot dog shit. Oh yeah, the S&P is dumping. Look at this weekly. I mean, this weekly chart in the S&P 500 looks like just hot trash, man. And now we are getting back below that 50-week moving average, this green line. That's not good. That ain't good. If we let's look at Bitcoin. So Bitcoin is doing something interesting. I've seen a lot of people talking about Bitcoin and how this 50-week moving average, I don't know why my voice keeps cracking. This 50-week moving average on Bitcoin has been a nice indicator of when it's about to enter into an uptrend or when it's about to enter a downtrend. If you look back here in 2018, we get below that and we dump. And then back in 2019, we get above it, we skyrocket. Over here, COVID was a bit of an anomaly, so ignore that. But you can see this entire bull cycle, we stay above this green line, we pull back to it, we bounce off of it, and then the real dumping on Bitcoin started back in when else but December of 2021, just like stocks. We dump, we try to get above it, and then we continue to dump, and now look, we're doing the exact same thing. We wicked up above it, and now we're rejecting it. And I talked about that on my Bitcoin video from last week, how 25K, that's the number. And sure enough, to a dot, we have rejected off of 25K. Or basically 25K and like 200. Yeah, basically. I mean, we rejected off of it like perfectly. And now Bitcoin is just heading down with equities. So Bitcoin's just a nice way to read how risk on money is getting in the market, because there's nothing more risky than Bitcoin in my opinion. I mean, yeah, stocks are risky obviously, but I would say Bitcoin is way more risky than the Nasdaq, obviously. I don't think that's a hot take at all. So it's a good read on how risky things are getting. And then you'll look at this, if I can clear up, make this, how do I I don't even know how to work this stupid thing. Make this line a little bigger. Just make it blue. Ah, there we go. Thickness right in front of my face. Jesus Christ. So we're also rejecting off of the 200-week moving average on Bitcoin. I mean, it's just crazy, which you can see the 200-week moving average has been support on Bitcoin for a really long, back here in 2015, we bounced off that 200-week moving average. We bounced off that 200-week moving average back in December of 2018. We bounced off of that during COVID. So we have broken below that. We tried to get above it back in August, rejected. We tried to get above it back here. So look at this confluence. I mean, we have the 50-week crossing below the 200-week. It hasn't crossed below the 200-week on Bitcoin in recorded history. I mean, damn, dude, that's a little freaky. That's a death cross kind of thing going on there on Bitcoin. So anyways, right now, I mean, the Nasdaq's basically sideways on the day. we're looking towards Friday. Friday, we get that PC read on Friday morning. I think that is everything. That's make it or break it for the market right now. And that is going to be what decides the direction of the market for I think for the very short-term future, for the next month or two. If that PCE number comes in red hot, that is just going to completely destroy all of what the Fed was talking about last meeting. It's going to completely derail the bull thesis, if it already hasn't been derailed. In my opinion, it basically has. And that is going to decide where the market goes for the next month or two, if not the next like 6 months. Who knows? But we'll wait and see what happens then. Right now, I'm short on Apple. It is holding up pretty decently. I mean, the whole market's just kind of holding up today. It's just a big nothing burger. The FOMC minutes is just a complete joke. I mean, I don't know why the market reacts to it at all, because they basically just say everything we already heard. So it looks like the market just doesn't really care. Today is just a sideways chop day. S&P is down a quarter. I mean, I guess the S&P is making new lows. I mean, yeah, if we look at SPX, we tried to get above 4,000. Whoa, man, we rejected 4,000. Things ain't looking good, man. Things are not looking hot right now. I'm not going to lie. I ain't going to lie, sis. Anyways, I appreciate y'all for watching. I would ask if you could please subscribe, drop a comment, drop a like if you enjoyed, and we'll keep this thing running. We'll see. Friday's the big one, man. I'm going to drop a video on Friday. That's going to change everything. I'm not trying to hype or clickbait here. Friday's PC number is going to change everything if it's red hot. So we'll see you guys on that one. Peace.